Hello everyone, welcome back to my channel. This video is going to be uploaded on YouTube a little bit later than I expected, but I have a few issues with my internet connection here, the place where I'm at, so I could not upload it any sooner than this. But yeah, let's wrap up week one of this challenge. And yeah, it's fair to say that this was not a positive week for us. Basically, things were going rather smoothly all the way up until Wednesday. But then on Wednesday, the Federal Reserve, which is the central bank of the United States, decided to keep interest rates as they are, even though they gave a slight hint that interest rates may be lowered on the next meeting, which will take place in mid-September, September the 17th and 18th. But this outcome of the Fed meeting, along with some economic data in the United States, in particular the jobless claims and some manufacturing data, gave the impression to the investors that the economy is already stopping its momentum. Growth momentum is slowing down, and the Fed is not doing anywhere near enough of a job to stimulate the economy to counteract this economic slowdown. And so both on Thursday and on Friday, markets panicked a little bit, to say the least. And yeah, basically those 2 days were something resemblant of a market crash, and so a lot of stocks suffered with that particular situation. But yeah, let's survey the results of this week. So, as you saw in my previous video, I had several covered calls on American Airlines, SLOD, Ford Motor Company, and HIMS, and I also had some cash covered puts. Namely, I sold some puts on CMCSA, Comcast, and SLOD, and also on Pfizer. And so let's see basically what transpired during the week. So let's see, these were the trades that I input on last Monday. So basically on the next day, on Tuesday, the Pfizer stock had a slight run up. It rose for quite a lot, and so the put that I sold went almost worthless. And because of that, since we had sold it actually, the Pfizer option, the put option, for 30 cents, because in one day we were able to realize about 90% of the value of the option. I decided to bought back the puts that I had sold the day before on Monday, and so I bought them for 3 cents. So these were €3 each, and so we need to input this in here. So basically we managed to close the trade the next day. Basically, let's see, so it was on 30th of July here. Basically the next day we bought it back, and so we closed the trade at 3 cents. We had in commissions, let me see, so 1.43, so we have to input here 1.43, and so basically we closed this position. All right, this was the return. It was a quite nice return, I should say, for only 1 day that the trade was ongoing. And then The next ones were pretty still. So because after I bought back the puts, the collateral on these options were released, and so I decided to sell 3 options on Bristol Myers Squibb because the premium was rather nice. This is a high quality stock in my view, and so basically I decided to sell 3 puts on 28 cents each with a fee of 135, and so let's add this to our trade. So basically on the same day, on Tuesday, this was also a weekly put, so this expired also on the August the 2nd, so last Friday, as you can see right here. All right, the strike was 48, and so let's update here our chart. So this was on Bristol Myers Squibb. This was a cash covered put. The strike was 48. Those were 3 contracts. Each of those contracts was 28, and I believe the commission was 143. Sorry, 135. So 135. All right. And so this trade, as you can see right here, the puts expired worthless. So the strike, so the stock ended up, even though I must say it was odd, because on Wednesday, the next day after I sold these puts, the stock price ended up below 48. It actually ended up very close to $47, but during the market sell-off on Thursday and Friday, the stock ended up the stock price ended up being upward, and so it cleared for I think quite a wide margin the strike that we had in place, which was 48. Actually, it was a little bit closer than I expected, but yeah, it still ended up above the strike, so that's why the put option expired worthless, as you can see. And so basically there it simply expired with no commissions to play. It expired, and so yeah, it was also a quite nice return. It expired when it matured, of course, here 3 days, and so this is the return. It was also quite good, as you can see. And so let's move on to the next trades to see what happened. And so yeah, here on August the 2nd, which was on Friday during the so-called market sell-off, the covered calls that I had on Ford Motor Company, which were due to expire now this week, the end of this week that's going to start tomorrow, on August the 9th, they ended up being valued at 1 cent. And so I decided, all right, let's not going to wait another week, all right, until next Friday for them to expire. We can buy those back because they are already at 1 cent. It's the minimum value that they can have. Let's buy those back, and so let's roll over the position. All right, and this is kind of a tricky trade that I need to explain a little bit more, but we'll get to that. And so it was we bought back the 4 calls, all right, at 1 cent each. The commission was 207 here and minus 41 cents. So as you see, if it was 40 cents, it was 167, so it's 166. All right, so here the commission was, just for me not to forget, it's 166. We bought those back at 1. All right, we closed the trade. Yeah, this is actually it. Yeah, this was the date this trade occurred. Yeah, it was not a very good return on this. of course, because yeah, we sold these options for quite quite a few, or not a few, for very little money. So that's why the return was so low, but we decided to roll over this position, and this is a kind of a tricky trade, and I tell you why. I bought these shares for the cash covered put at 13, but as you can see right here, if I show up the options chain on 4, as you can see here, for the following few days, the strike at for the $13 call option is 1 cent, and so this is even 2 weeks out. So this is for the 2-week option, and so this was a very low premium for me to sell these calls, and so I decided, all right, this is basically not worth it. I am going to take the risk, and this is a decision that I decided, of course, on the spot, because this is a kind of a risky trade to do it, because I'm risking losing basically $2 on each stock, and basically, since there are 4 contracts, these are 400 stocks, so €2 each is 800 euros. All right, of course, I stand to lose a little bit less because I received some premiums in the meantime, but I decided to roll over the position by selling calls on for August the 16th, so basically 2 weeks out, or rather 3 weeks out, for at a strike of 11. So if by this time the stock price ended up exceeding 11, yeah, I'm gonna realize a loss of about 700, high 700s dollars. And but why did I do this trade anyway? First of all, because I wanted to roll over the position. All right, I want to continue to collect premiums, even though this premium, of course, is very low anyway. But also the reason why it's low, it's because the stock has a relatively low volatility, and so I remember when I sold these puts, the probability of profit, meaning the probability of the option expiring worthless, so the stock price never reaches 11, which was right here. This is the exact one that I did. The probability of profit was about 91%, and so I decided, all right, even though I don't know what market's going to do the next week, but it's possible that there is a rebound in the market after the 2-day sell-off that we witnessed last Thursday or Friday. So a rebound can happen, of course, but the stock is currently at 10. Is currently priced at $10 roughly, and so it would have to rise €1. And given that historic volatility is about 48, yeah, basically it's not that likely that this is going to happen, and the probability of profit based on historical volatility is it was above 90%. So I decided, all right, let's take the risk, even if I ended up losing the trade, meaning the stock is going to get sold at 11, even though I bought it at 13. Yeah, let's take the risk, because the only thing I don't want is to have the stocks and not getting any return out of it. All right, and so I decided to take the risk. It's a calculated risk, even though I'm risking losing quite a bit of money, of course. But this is not a trade that I recommend. But yeah, it is what it is, and let's see what happens. Even if I lose, all right, it's a slight hit, but at least the stock goes away, and I get some money back, most of my money back, to invest in better quality stocks. And so yeah, let's see what happens. But so I decided to roll this over and sell another call. All right, so I did this trade at this time with this maturity. This was for motor company. This was a covered call. The strike is 11. All right. Sorry. And these were 4 contracts. Each was 5 cents. And let me see the commission. It's right here. So it was, wow, and the fees were actually quite high. So this is 409. These are quite steep commissions. I was not expecting to be this high. Basically, yeah, out of 20 euros that I got in, $20 that I got in premium, I basically had to pay 409. So this is quite a steep commission, but yeah, it is what it is. No problem. We'll get out of this eventually. So yeah, this one is done. All right. So I bought this back. Also, another thing that I did as well was that I bought back some American Airlines options, the calls that I had, because they were already priced at 1 cent because of the market sell-off. I didn't realize it. Apparently, yeah, this was after I put the trades, and then I got out of my computer, so I didn't realize. So yeah, basically I need to write this straight down, but apparently because it's 1 cent, probably what I will do tomorrow on Monday is to buy back these calls and then roll over the position further. But I'm going to see, or try to see, what happens to the market, because what happens to the market is going to be important in terms of setting up the strike price for the call options on American Airlines. So we will see what happens, but in the meantime I'm going to register here that we sold some of the calls. Let me see. Yeah, because the trade was a partially filled trade. I'm gonna have to get back on this probably, but let me see. So what I'm going to do here is basically this and this, and so let's copy this here, because these were 9. Let's assume, all right, this is 6 and here is 3. All right, this is for 9, so let's pull the calculator here. All right, and so these are 2, 5, 9 plus 6. Right, so basically these were 8 through 3. This is an adjustment that I need to make because, as you can imagine, I was not expecting for the trade to be only half filled. So yeah, so 411666. Is this correct? Yes, this is correct. And so this was also, these were all sold at 4 cents. Now these are 9 cents. What I'm going to do this is put here 6, and here, sorry, and here I'm going to put 3. just to make it that 9 cents that we had initially. And now here I sold these at 1 cent. I paid in commission, let's see, 114, right? 114 here, and this trade was closed here. All right, let's push this up. Right, this trade was closed here. All right, and here, let's take this off. All right, now it's done. Yeah, this was a slight adjustment that needed to be made, but whatever. And now let's go to see the options that actually expired worthless. So HIMS, of course, it expired worthless. These that were still here from the previous week, they expire worthless. So the trade stopped in here. They expired worthless, expired. Right, and so one thing that I'm going to do here, and I forgot to do it with American Airlines as well, but yeah, let's do this last. Also CMCSA or Comcast also expire worthless. Let's see here, and I forgot also HIMS here. Yeah, there was one option here that also expired worthless here. All right, these both expire worthless. Good. Next up, actually, if you recall, I had the strangle. For those who don't know, a strangle is I sold out of the money put, which was the SLOD at 96, and I also sold a call, which was also out of the money, at 103. All right, and this call expired worthless, but because of the market sell-off, the put actually was exercised, meaning the stock price went below 96. And so, even though I must say the the stock price survived the first sell-off on Thursday, and so I think it finished the day below 96, so it stayed within the range between 96 and 103. It didn't survive, to quote unquote, it didn't survive the second sell-off, and so it ended up being assigned. All right. So again, just to emphasize here, it was assigned. I had to buy these shares at 96. All right, because it was a strike price. Let's see. This is not the stock, right? This is the one. All right. It ended up here at 95.50. So basically, I bought for $96 a stock that was valued at 95.5. So this is basically 50 cents on each one. All right. Actually, as you can see, because it was, of course, this is mark to market. It really doesn't mean that much, but because I received the premium 55 cents, all right, for each call option, for each put actually, and because the difference between the strike and the stock price when the stock was bought was only 50 cents, on mark to market basis I ended up having a profit, all right, because I received 55 when I sold the puts, all right, and again here, as you can see, I had a cost of I had a cost of 50, so I ended up having a gain of $15. All right, which is not significant, but still it was a win when was expected to be a loss. But that's not really a big issue. All right, and so I think all the trades were done, and so yeah, let's see here. I think all the trades, yeah, they are done. So I have to put here in the comments that I bought 300 shares. All right, here, let's put here. I bought 300 shares. I also forgot to put here as well that I bought 200 shares previously, and here that I bought 100 shares, because this was the previous 300 shares that I bought from Estée Lauder. All right, so I'm going to put this yellow because I want to keep track of what stocks I'm acquiring because of the puts are exercised. And so what I'm going to do now is in order to keep track of the wins and losses that I'm having, what I'm going to do is the following. I'm going to look here for the HIMS stock, which is right here. And so what I'm going to do is basically I'm going to add up here the outcome of the trade of these HIMS stocks that I had bought previously. All right, and so as you can see right here, these were let me see where they are. So here is one, and the other HIMS stock, which was right here. So I had to add this one here, all right, because these were the stocks, the HIMS stocks that I bought at 23, and in here I'm going to add up these 100 stocks of HIMS that were in here. All right, and so basically this is it. All right, it's 163. All right, why do I do this? Because now this calculation here, because this is the profit and loss of the wheel, but this allows me to see what is the strike price of these options that I can put, that I can set up, so that I would break even. All right, so if these stocks that I bought for 33.50, if I can conceivably sell a call for a strike of 22.20, I would still break even though this strike is lower than this one. I would still break even. In this case, these 100 shares of HIMS I bought for 22.50. I could sell them at 19.92 in order to break even. Why is that? Because I received some premiums in between. All right. So what's going to be the strike that I'm going to put on these stocks, on these calls for these stocks next week? It really depends on what's going to happen to the premiums, and yeah, I will keep this in mind. But for the time being, it's a decision that I will have to take on the spot. I cannot tell. I can't say what I'm going to do, because at this point I don't have any information on the option chains that will be happening tomorrow, and so yeah, basically I can't make a decision at this point. So for the HIMS stock, this is it. All right, there were some American Airlines stock that I bought back. All right, but I'm going to wait until tomorrow that I sell the remaining ones in order to make a calculation of all of this. All right, but then we'll see. For the calls of Estée Lauder here, I'm going to add here the gains that I had on these options that expire worthless here. All right, and as you can see, now I could sell these for 98.23. I would still have a profit even though I bought them for 100. For the 4, which is right here, I can also here, the 4 is right here, right? So this is meaningless, so I would still have to sell them by around 12.86 in order to break even, which is basically meaningless, as you can see. This one, yeah, this him stock also expired. What else? I think this is all, if I'm not mistaken. The lift is still ongoing. The lift option is still ongoing, so I haven't settled this trade yet. The call is still in here, and basically this is it. I'm going to see what's happening to this American Airlines stock here. When I sell the remaining American Airlines calls, I'm going to get this thing back in one single line, so that then I can make the calculation of for how much I need to sell these American Airlines stock in order to break even. All right, because it's easier that way, but just for the time being, this is better to keep track of things. And so far, yeah, this is it for today. We keep track of everything. This one is the new call ongoing for 4. This is still ongoing for American Airlines. We have still this covered call for Lyft, and we'll see tomorrow how things will unfold. We will see if the market rebounds, if it stays also depressed, just like last Friday and Thursday. And yeah, fingers crossed to see what happens. Of course, as you can see right here, the unrealized losses are significant at this point, but as long as we can get out of the trades with this, at least an approximate price for the price that we bought these stocks, we will be absolutely fine. And keep in mind that even though of course we are having unrealized losses, for example, Estée Lauder is a very, very good stock. I don't mind having this unrealized profit, unrealized loss, because if I keep the stock for the long run, the stock for sure will eventually get out of this price and will rise ultimately. And so I'm very confident about this stock, so I don't need to worry. For me, the main points of concern is American Airlines, for HIMSS and Lyft, which are the stocks that are giving me more trouble. All right, and so we will see what happens. Feel free to leave any comments below, any questions. I will also take some time when I have a little bit more time available to talk about a little bit more about this strategy. Why do I sell options, and what are the intrinsic characteristics of the trades that I do, meaning selling options, that allow me to profit from this strategy. But that will come for another video when I have a little bit more time. All right, so yeah, we'll keep them coming, and for the time being, I'll see you tomorrow on Monday at the end of the day with the trades that I did for the following week. So yeah, I'll see you next time.